Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Fundamentals of Valuation Methods. Fundamentals of valuation methods are crucial in understanding and managing risk within corporate finance. Valuation methods provide a framework for assessing the worth of an asset, project, or company, which is essential for making informed financial decisions. These methods are integral to various aspects of corporate finance, including investment analysis, mergers and acquisitions, and financial reporting. The three primary valuation methods are the discounted cash flow method, the comparable company analysis, and the precedent transactions analysis. The discounted cash flow method is based on the principle that the value of an asset is equal to the present value of its expected future cash flows. This method involves forecasting the future cash flows generated by the asset and discounting them back to their present value using an appropriate discount rate. The discount rate typically reflects the riskiness of the cash flows, often represented by the weighted average cost of capital. The DCF method is widely regarded for its theoretical soundness, as it directly ties the value of an asset to its ability to generate cash flows over time. However, the accuracy of the DCF method heavily relies on the quality of the input assumptions, such as growth rates, discount rates, and terminal values. For instance, the 2008 financial crisis highlighted the challenges of forecasting cash flows and determining appropriate discount rates in an uncertain economic environment. The comparable company analysis method involves valuing an asset by comparing it to similar assets with known market values. This method typically uses valuation multiples, such as the price-to-earnings ratio, enterprise value to EBITDA ratio, or price-to-book ratio, derived from a peer group of comparable companies. The CCA method is widely used in practice due to its simplicity and reliance on market data, which provides a benchmark for valuation. By examining the valuation multiples of similar companies, analysts can estimate the value of the target company. For example, if a peer group of companies is trading at an average PE ratio of 15x and the target company has earnings of $10 million, the estimated value of the target company would be 15 by $10 million equals $150 million. However, the CCA method has its limitations, as it assumes that the peer group is truly comparable and that the market values of these companies are accurate reflections of their intrinsic values. The precedent transactions analysis method involves valuing an asset based on the prices paid for similar assets in past transactions. This method is particularly useful in the context of mergers and acquisitions, where it provides insight into the premiums paid for control and strategic synergies. The PTA method typically involves identifying a set of precedent transactions, analyzing the transaction multiples, and applying these multiples to the target asset. For instance, if recent transactions in the industry have been completed at an average EV/EBITDA multiple of 8x, and the target company has an EBITDA of $20 million, the estimated value of the target company would be 8 times $20 million equals $160 million. While the PTA method provides a market-based perspective on valuation, it also has limitations. The availability and relevance of precedent transactions can vary, and the specific circumstances of each transaction, such as strategic motivations and market conditions, can significantly impact the transaction multiples. Each of these valuation methods has its strengths and weaknesses, and the choice of method often depends on the specific context and purpose of the valuation. In practice, analysts often use a combination of methods to triangulate the value of an asset, thereby increasing the robustness of their valuation estimates. For example, in the valuation of a privately held company, an analyst might use the DCF method to estimate the intrinsic value based on the company's cash flow projections, the CCA method to benchmark the valuation against publicly traded peers, and the PTA method to consider the prices paid in recent transactions within the industry. By integrating these different perspectives, the analyst can arrive at a more comprehensive and reliable valuation. Furthermore, the application of valuation methods must account for the inherent risks and uncertainties associated with the asset being valued. Risk management is a critical aspect of valuation, as it influences the discount rates, growth assumptions, and ultimately the valuation outcomes. For instance, in the context of DCF analysis, the discount rate should reflect the risk profile of the asset, including factors such as market risk, industry risk, and company-specific risk. Similarly, in the CCA and PTA methods, the selection of comparable companies and precedent transactions should consider the relative risk profiles to ensure meaningful comparisons. Moreover, the integration of valuation methods with risk management techniques can enhance decision-making in corporate finance. For example, scenario analysis and sensitivity analysis are valuable tools for assessing the impact of different assumptions on valuation outcomes. Scenario analysis involves evaluating the valuation under different scenarios, such as best case, base case, and worst case scenarios, to understand the range of potential outcomes. Sensitivity analysis, on the other hand, involves changing one assumption at a time, such as the discount rate or growth rate, to assess its impact on the valuation. These techniques provide insights into the key drivers of value and the potential risks associated with the valuation assumptions. To illustrate the practical application of valuation methods, consider the case of a technology startup seeking investment from venture capitalists. The startup's valuation will be crucial in determining the terms of the investment and the ownership stake offered to the investors. Using the DCF method, the startup's management can project the future cash flows based on expected revenue growth and profitability, and discount these cash flows back to their present value using a discount rate that reflects the startup's risk profile. Additionally, the management can use the CCA method to compare the startup's valuation with similar publicly traded technology companies, considering factors such as revenue multiples and growth rates. Finally, the PTA method can provide insights into the valuations achieved in recent venture capital investments in the technology sector. By triangulating these different valuation methods, the startup's management can arrive at a more informed and credible valuation, which can facilitate the investment negotiations. In conclusion, the fundamentals of valuation methods are essential for understanding and managing risk in corporate finance. The DCF method, CCA method, and PTA method each offer unique insights into the value of an asset, and their combined application can enhance the robustness of valuation estimates. Effective risk management is integral to the valuation process, ensuring that the assumptions and inputs accurately reflect the underlying uncertainties. By mastering these valuation techniques, finance professionals can make more informed decisions, optimize value creation, and effectively navigate the complexities of the corporate finance landscape. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.